And Celeste just hit recording, and so we will have this session on record. We'll talk about that in a minute. And so welcome to the Alaska Community Foundation's webinar on the topic of endowed funds. Today we have a lot of information to cover regarding the permanent endowments that you have established, you or your organization have established here at ACF. My name's Elizabeth Miller. I'm the Vice President of Development and Communications here at ACF. And I'm just going to do a brief welcome and overview of the session and introduction of a couple staff people who are on the call. As I said just a few seconds ago, the session is being recorded and it will be available for viewing via our website later. So if you know of people who had intended to join with you but were unable to, you'll be able to share with them the link or send them to our website to find the link to watch this video. We do ask that you hold your questions until the end of our presentation. Or if you want, go ahead and put them in the chat box when the question comes to you. And if the question hasn't been answered by the time we get to the Q&A session, we will look at those questions in the chat box, as well as taking questions from you verbally at the time. I like putting them in the chat box because then I don't forget them. So you're encouraged to do so if you wish. We have scheduled an hour, just about an hour, from 4 to 5 for this session, and that should allow for plenty of time to answer your questions at the end. And we do ask that you remain muted until the question and answer portion. So, Kevin, next slide. The topics that we're going to cover today are listed on this slide and include overview, of course, of endowed funds that are here at ACF in perpetuity. And then how and why those funds are invested, how much of the funds are available for distribution with a focus on ACF's spendable policy. And before final thoughts and the Q&A session, we'll also talk about what happened in the stock and bond markets in 22 and 23 and the implications for us now and going forward. So ACF staff members who are on this webinar with me include Celeste Early, and she is our philanthropy officer. Janelle Hodge, who is our Director of Finance. And we also have two other finance team members, and that is Catherine Helberg and Antoinette Sabong. And also with us is Michelle Murphy, our Donor Services and Office Coordinator. If you've been to our office or called our office, you have probably talked to Michelle. Also with me, very importantly, is Kevin Gray, our CFO. Kevin has been with ACF for 8.5 years, and he is our primary presenter today. So with that, I will turn it over to Kevin.
Well, hello, everyone. Thanks for coming today, and thanks, Elizabeth, for that introduction. We will talk a little bit about all the things you see on your screen right now. The first being endowments, and kind of talk a little bit about what they're about. We'll talk about investing funds for the long haul, the calculations that come with the spending policy, which we'll have to get into the weeds a little bit for that. So bear with me as we go through some calculations, and then we'll talk a little bit about final thoughts. So without further ado, let's talk about endowments. They're here forever. Perpetuity is an interesting word, but let's give some examples of some that you might have heard of before. Two very famous endowments are the Harvard University and the Yale University endowments. The Harvard Endowment has been thoughtfully built over about 385 years. It's worth over $53 billion, that's with a B, today, and distributed about $2.4 billion to support Yale University's operations and students in the last year alone. The Yale Endowment started in 1718 with a gift of 562 pounds, not dollars, pounds, and has grown to over $40 billion. Alaskans might be more familiar with something called the Alaska Permanent Fund. That started with an initial deposit of $734,000 in 1977. Today, it's nearly $80 billion and a distribution of $1.8 billion this year. Similarly, Norway created their sovereign wealth fund with its first deposit in 1996, and today it's worth over $222 billion. There's there's several common denominators in each of those examples. Time, 300-400 years in some cases. Continuous deposits by people that are willing to support those particular things, or the states or the countries. And controlled withdrawals or distributions from those funds, and investment earnings over the lifetime that they've been created. At ACF, endowments are similar. They're perpetual. They're a group of assets or a pool of assets that we intend to support either a cause, a nonprofit specifically, or perhaps a purpose of some kind. They're structured so that the contributions that are made throughout the lifetime of that fund are protected. They're kept in something we call the principal. That value is kept there and inflation protected, or proofed, if you will, over time, so that whatever has been deposited in the past is worth the same thing in the future, which we all know a dollar today is not worth the same as a dollar 100 years from now. Endowments are designed to create an unrestricted revenue stream to support your cause or nonprofit or fund. And it has no immediate expectation or a real time horizon that is immediate in nature. And by immediate, I mean something less than 20 years. And we'll talk a little bit more about that. Our endowed funds are invested, just like the ones I cited as examples. Typically, they're pooled together with other funds here. Just so you know, we manage about $240 million worth of charitable assets. Our long-term pool is about $198 million currently. And we have some more assets that are outside of that pool, the short-term pool, and some other assets, which make up the balance of that $240 million. They're managed both by passive index funds, which you may or may not be acquainted with. We'll talk a little bit more about that in a minute. And active managers who are managing specific portions of that endowment or pooled assets. And they're invested according to something we call the IPS, which is an investment policy statement. You can find that on our website if you want. And I'll tell you how to get there in a minute. And that's governed by our investment committee. But it has some main ideas. Investing for the long haul or perpetuity. It's a diversified pool, has a number of asset classes, which we'll go into. And we want to avoid specific risk within, if we can, in investing. There's always risk in investing. So what are they? Our ACF board of directors created this investment policy with some ideas in mind, specifically the long-term growth of that capital or original amounts, emphasizing long-term growth and avoiding risk where we can, and inflation proofing, or keeping that purchasing power the same over time. So what does our investment pool look like? Well, it looks like this. We have about 53.5% in something called global equities. Those are stocks. We are tilted pretty heavily towards the United States stocks. About 81% of the equities are in US stocks, about 19% are in international stocks. There is something called global fixed income, which again is global in nature, but is fixed income products like bonds, debt instruments of entities, including the US government, TIPS, which are inflation, treasury inflation protected securities issued by the US government, and other income and interest rate sensitive devices. We have about 9% in real estate, or real assets, I should say. Those are things you can touch. Those include public and private investments in real estate, natural resources, energy, culture, timber, that kind of thing, infrastructure. And then something called diversifying strategies, which are things that are going to move separately from the markets that were described in the previous portions, equities, fixed income, or diversifying strategies, real assets. They're commonly referred to as hedge funds, but more importantly, things that don't move with the markets, and those may not necessarily just be something called hedge funds. There's also good old-fashioned cash of about 2.5%, so that we don't have to sell assets quickly in order to distribute funds if there's a call to do so. So one of the things that endowments do are controlled withdrawals or distributions from those funds. So we have money coming in both from contributions or donations into the fund, and we have investment earnings over time that are going to add to that, and then distributions that are coming out of that fund. And those are controlled in what we call a spending policy. They're structured to get the benefit of good investment years, but still protect that original principle. And that principle is the value of all the contributions that have ever been made to the fund over time. And we're trying to protect that against any market downturns, or in the good years, positive returns. Our board of directors sets that rate, or the spendable rate, we call it, annually, considering a number of factors that are required by a law. The law is abbreviated there on the screen, MIPFA. It is the Uniform Improvement Management of Institutional Funds Act, which actually was a federal act and then incorporated by nearly every state in the union, Alaska being one of them. And it requires a number of things that we do to protect that principle, or those contributions to endowment funds here at ACF. And those include the returns for a period of time in our portfolio, inflation, the expenses associated with investing and managing those funds here, general economic conditions that are outside or inside Alaska, and the nonprofit environment here in Alaska, as well as other considerations. That spending policy percentage that the board sets is then applied to 16 quarters of fund balances, of your fund balances, to smooth out fluctuations in the markets, contributions coming into the fund, distributions going out, expenses, and everything else. So as that fund balance fluctuates, we take that over 16 quarters, 4 years, to try to smooth that out. What has our spending policy percentage been? Well, here it is from 2008 on. You can see that it generally has hovered around the 4% mark, but it moves around a bit. And in 2024, you can see that it dropped down to 3.5. 2025, the board decided that it should go back up to 4.25. So once that percentage has been decided upon by our board of directors, now the fun part begins, and we're going to get into the actual calculation of an example fund so that you can see how this works. So now we're going to get down the weeds a little bit, and I apologize, but there's really no other way to explain this. So here we go. this is an example fund. You can see that 4-quarter average ended in Q3 of 2024, or September 30th of 2024. Going backwards 16 quarters drops you into the fourth quarter of 2020. And you can see this fund started with about a $25,000 balance at that point, moved around and upwards for the most part with contributions and earnings, and it's now got a balance in the Q3 of 2024 of $157,000. The average of all those quarters, if you were to do the math, is 96,000. So what's its spendable calculation? Well, the initial calculation is that we take our spendable percentage for 2025, which was that 4.25% from that previous table, multiply by that 16-quarter average of 96,000, you get $4,080 that this particular fund is allowed to spend for the 2025 year upcoming at the time. By the way, we send those calculations out to endowed fund holders in December of each year after our board has made that decision for the spending policy in November. And it will show you this calculation in that letter so that you know where it came from. There is one final test that we have to do to ensure that we are keeping that fund balance above its original principal amount or those contributions throughout the lifetime of the fund. And we compare that fund balance first, the 157,000, against its original principal amount, which happened to be for this particular fund, 128,000. That difference is about $129,000 difference. It happened to have a unspent spendable from previous years accumulated of $5,950. So when you take the $5,950 and you add the $4,000 2025 amount to it, is that less than the 29,000? In this case, it is. It's far less than that. And so that entire amount of $4,080 would be allowed for this fund to spend in this coming year of 2025, if that's what that fund and the fund advisors within that fund were wanting to do to support that cause. As I said, those distributions to an agency, in the case of a 501c3 agency that holds a fund here, would be unrestricted revenue to that entity. They can do with it what they want, unless that endowment was made for a specific purpose, which sometimes they are, like for a building, let's say, or something else. But generally, it's unrestricted revenue because generally they're set up to support the operations of the entity. If your fund supports a purpose or a cause, then that's slightly different. Then the fund advisors can determine where that money is spent and how that money is spent. It might be a donor advised fund. It might be designated for a particular charity, or it might be a field of interest, in which case ACF is making some of those decisions along with a committee. That's the example calculation. I'll let that sit on the screen for just a minute, but the basics of it is that 16-quarter average. We apply that new spending policy percentage that the board makes every year to calculate what could be spent, and then we test that against the balance and the amount of contributions for over the lifetime of the fund to make sure that we're not pushing that fund balance down. That generally doesn't happen unless there's been significant downturn in the markets. And that has happened over the history of ACF, and it will continue to happen far after the time I'm here. But let's go on to the next slide now. So in summary, endowments are perpetual. They're here forever. They're structured so that that principal amount is protected over the lifetime of that fund forever. And a portion of those funds' earnings over time can be spent utilizing that spending policy or controlled spending that we talked about. So that's the summary of what an endowment and the spending calculations are all about. Let's talk a little bit about life and in the markets, because it's not always predictable. It certainly isn't. If you look at your retirement balance or something like that you might see, or even if you're a market nerd like me, you'll look at something on the screen every day and you'll be interested in what it does, but it goes up and down every day. The markets, just for fun, today we're down. Um, I won't describe why, but at least there are daily and monthly and yearly movements. 2022 was a very strange year. It was a perfect storm year, one where over 100 years hadn't happened, where both stocks and bonds went down in the same year. Generally, they operate in opposite form of one another, but this particular year was very interesting. And our portfolio weathered that storm, did better than, let's say, the S&P 500, which lost 23% in that year, but it still came up with a negative return that year of 13.25%. In 2023, we saw some of that stabilize. The inflationary pressures were somewhat relieved, although not completely. You still hear talk about that today, and you still will. The Fed made a decision today to pause in its interest rates to try to keep inflation at bay, just today. But as that stabilization occurred, our portfolio returned 14.28%. We were back moving the other direction. Through September of this year, our portfolio had returned 12.71%. And our 5-year return in that portfolio at that point was 8.74. So I would say with our conservative portfolio, those are good returns. Certainly in a negative environment in 2022, that was challenging. Here are our investment portfolio returns a little more in a table format. That 12.71% I mentioned as of September 30th. Our preliminary results for up through the end of the year is just about the same. It's 12.84. I don't have the final results yet because we're still waiting on some information, but that's roughly where we are. The 1 year, 21.4%, that's 1 year from September working backwards, not calendar year. The 3-year and the 5-year returns are there. We compare ourselves to two benchmarks. One is what we call the balanced index. You can see that is kind of like a 60-40 portfolio, a little bit different, 60% in worldwide equities, 30% in bonds. The BB aggregate is a bond aggregate index of some kind by Bloomberg. The 10% in US Treasury inflationary protected securities kind of offsets some of that inflationary work. And so we test ourselves against that. You can see the balanced index returns that would they're hypothetical. And the investment objective benchmark is actually specific to each of our underlying investments. We have over 17 managers who manage portions of our investment portfolio. We test each one of those against their own relative benchmark. And that investment objective benchmark is made up of all of those relative benchmarks. So it's an average of an average, let's put it that way. So let's sum up kind of some of the things that you've seen so far. We have a long-term strategy in our investments. They're 20 years plus in terms of a time horizon. So we're not chasing NVIDIA, and we're not chasing cryptocurrencies, and we're not chasing the latest buzzword in investing. We're staying disciplined, and we'll talk a little bit more about why we do that. We stay invested throughout the markets, even though there may be ups and downs, and there certainly are, and it's a bit of a roller coaster ride. And we'll explain that why here in the next slide. But we rebalance periodically as portions of our portfolio move independent of one another. So if stocks are up, we might take some money out of that and put it in bonds. If it's the other way, we'll take some money out of bonds and put it in stocks. And finally, time is your friend. And I'll show you a slide that is really interesting with respect to that. But remember some of the things we started with here too, which were the Yale and the Harvard ones have been around for 300 years plus. And that really is the idea of an endowment. We talked a little bit about staying invested. This is a slide about that. The slide shows if you were to miss certain things in the markets, what might happen to you. So if you stay fully invested, your $10,000 was worth $46,257. That's over a 10-year period ending in 2021. This is a little bit old, but this still holds true throughout even the last few years. If you miss the one best month out of out of that 10-year period, 1 month, then all of a sudden your amount goes down to 41,000. You miss the best 3 months out of that 10-year period, bang, you're down at 34. And if you miss one whole year, you're at 19,000. So it just shows you that staying invested is a good idea, and trying to time the market movements up or down is very challenging, and you can miss out unless you're doing that daily and hourly in some cases. So we don't work our portfolio that way. We stay invested, and we do it with strict guidelines, which are outlined in that investment policy, in which we showed that slide about our asset allocation model. The next slide shows, I think it's one of my favorite slides, frankly, but it shows what has happened to the S&P 500, which is an index of 500 stocks, the 500 most valuable stocks in the United States, since 1928 up through 2020. And this shows you some of the massive world events, and yet you can see that line over that time frame, and it still keeps going up. We're talking about the Great Depression. We're talking about World War II. We're talking about the Korean War. We're talking about various crises that have happened, or wars, throughout that time frame, and yet that is going up all the time. The other really intriguing thing is that the positive annual returns of the S&P 500 were about 74% of that time, and the negative ones were only 26%. That's a 3-to-1 odds differential between positive and negative returns. What's that tell you? Well, try to go to Las Vegas and pick up those odds. You will never find it, but you will in the stock market. And so if you stay in the stock market over time and you have a diversified portfolio, in other words, you're not putting all your eggs in one basket, you're putting them across a bunch of baskets, you might do okay. Now, you have to be there for a long time for that to happen. And you can see over this period of time, from 1928 to 2020, you would have been okay. $1,000 grew into $9 million over that time. So that's the power of time, the power of investing, shown right there in one slide. So remember that they're here. Your endowment is here, and what can you do to manage your endowment? You've heard to some degree what we're doing, but you can do some work too. The first thing is to give your endowment some period of time to grow, particularly in the first 10 years of that endowment's life. Why do we want that to happen? Well, we want that to happen so that we build up a nest egg of earnings that can be distributed to your fund for the purpose it's intended, and not take that fund balance down below the contributions that have been made. We want that to be there for a while. So you have to let that build up. It'll be here in perpetuity. So remember that we're talking about the very long term here, and not just, gosh, it's been 5 years. What do I do? Or what can I get? An endowment is here for a long time. The other thing you can do is continue to contribute to your endowment and get your donors to contribute to your endowment if you're an agency. That builds that up as well. Our investment policy statement, or our asset allocation model that's a part of that, should produce solid returns in the over the long haul, 20 plus years. But don't expect that to happen year in, year out, because there will be times, as you saw from the 2022 returns, where we have a negative year. But it should be the primary determinant of risk and reward, in this case, returns in the portfolio over time. Final thoughts. Endowments are here in perpetuity, forever. And I want you to think a little bit about what forever means. Think about 100-year time frame, and how many generations within your particular family does it take to get to 100 years? How about your parents? Does that get you to 100? Probably not. Maybe grandparents, that might do it. It might be great grandparents. And if you think about that generational time frame, just to get to 100 years, think of Yale and Harvard getting there over a 300 or 400-year time frame, and you start to see what may happen. Think about the permanent fund, 1977 till now. Think about Norway's, which started in 1996 and has grown. All of those examples have monies that have been contributed over and over and over again, though, by various factions that are putting money in, government included. But think about your own endowment in that way. They are invested to grow that capital, to inflation proof them, and to provide sustainable grant making for forever, in perpetuity. They will go up and down. Investments will. Your balances will go up and down as a result of that. And if we control that spending, or we're prudent about it, we should be able to preserve that and expand it for future generations, which is the purpose of creating the endowment in the first place. And then the final lesson out of all that investment talk was that during market volatility, that's up or down or all around, it's best to stay in it, stay diversified, stay disciplined, and keep invested. And over time, that will work. It won't necessarily work every day or every month, but it will work. So that's the end of the presentation, and I'm happy to answer questions if I can. One caution or word of caution, if you want to talk about your specific fund, let's do that in a way where we're not talking about balances and things like that, because there are lots of people on the call. We don't want to reveal what your particular one is associated with others, but I'm open for questions. So do we have some?
Celeste, were there any questions in the chat box?
There are no questions in the chat box, but feel free to unmute yourself if you do have questions, or you can also post those in the chat and we'll be monitoring that.
I had a question about mechanics. I am fully committed to the idea of reinvesting in our endowment fund. I don't know, there's two questions, I guess. One is, how is it just an email to say, yeah, just reinvest our spendable amount, or how does that work? Because I see three labels. One's the fund itself, then the spendable, and then something else. That one confuses me.
Sure, great question. So initially, the way the calculation works is we're trying to come up with a number for the upcoming year, right? So the example, and I could maybe go back to that example to see if I can explain a little better here. If I can get my share to work here. There we go.
And Kevin, as you're looking, I want to clarify, Pete, the three words the labels that you see on your fund balance screen, I believe, is spendable amount, principal amount, and fund balance. Is that correct?
Correct.
Okay, Kevin.
And you're referring, Pete, to the visual in the fund portal, I assume, or
when I go and sign on to my account,
yeah,
where I'm sitting
okay.
at, yeah.
Yeah, so the spendable is an accumulation of the amounts that we were dealing with in this calculation. In this particular example, it would be the $4,080, whoops, and the $5,950 that had accumulated over time. And when we talk about what your spendable is, just because the calculation computes $4,080 in this instance, You may decide as the fund holder that you don't need all that money this year. You only need, let's say, 3,000. So you apply to us for a $3,000 distribution. That leaves you $1,080 still left in your spendable from this year, right? Every year that amount can accumulate if you wish it to. It is still invested, just like the principal amounts were. So there's no distinction between uninvested or invested spendable amounts. And it can accumulate over time. And the advantage to doing that is that you can control the distributions a little bit better uh, based on need, as opposed to whatever the board of directors for ACF is creating the spendable percentage this year. If you have some accumulated spendable amount, you can then spend it if you wish. If you've taken the distributions over time, then you don't have that sort of, I'm going to call it buffer that might be there otherwise. The principal amount is the amount of the contributions made into the fund over the lifetime of the fund. And then the balance is the sum of everything in the fund, principal, spendable, and any investment earnings that have occurred over time. And as part of that investment earnings calculation, we're trying to make sure that we're inflation proofing. The idea of inflation proofing is that the returns that we're expecting to make, generally around the 7%, 6.5% to 7% mark for that portfolio is supposed to produce, less the admin fee that you would pay on the fund, minus any distributions, in this case 4.25%, would be a positive and would add to that balance over time. And so have I described the answer to those three elements well enough, or did I confuse it more?
I guess, and well, I'm imagining, like say, oh, because I'm trying to convince my crew to say, let's reinvest into the principal. And if we do that out of the spendable, does that increase the permanent principal so that that's not going to be able to be drawn upon, right? And we're going to leave that one. And then but they're kind of feeling some pressure to want to use some of the spendable. And I was like, well, it's only been around for 3 years. Let's keep it in there, right?
Okay. Yes. So you do have the option of transferring your spendable back into the principal balance of your fund. I will say that in my 8.5 years, I think that's happened once on one fund. Most most people kind of keep it here as I'm going to call it rainy day account if they don't need the spendable. But yes, if you were to take the amount, in this case, the example, $4,080, and say, I want to add that to my principal, then it would obviously increase that principal balance, and that protection element would be increased as well. And that test that we're making every year to be sure that we're not bringing the fund balance below that would then have a little bit higher hurdle than it would in the past.
Okay. All right. Thanks.
Yeah, you bet. Great questions.
Other questions? Kevin, can you stop sharing for a minute and see if anybody's trying to wave their hand in their screen? You could use your raise hand icon, but we would take a physical hand as well. Any other questions in the chat box, Celeste?
Oh, just some thank yous from Sharon and Barb.
It's our pleasure. And, if you have questions about your specific fund, please don't hesitate to reach out. We can talk about the specifics of your fund or funds plural if you represent more than one. And so reach out to us and we're happy to walk through whatever questions you might have that are specific to your fund as well.
And I wanted to reiterate for some of you that joined after I gave some introductory comments, this session is recorded and will be posted on our website where you will be able to access it or even send a link to somebody else that might be interested in this information. And with that, if there are no more questions, we will give you 15 minutes back in your day.